Third part, most important part, how to manage risk. How to make sure that you lose less than what you anticipated to lose. This has kept me out of trouble so many times. Like a lot of people, they see the streams, they see the history, they see the results, and they're like, man, how can you lose so less? How are you able to lose so less? And let me tell you this right now. It's not all the time you're going to be able to manage risk. It's not all the time that you're going to be able to close 50% or close 60% or close partials as candle highs get broken or the lows get broken. It's not going to happen all the time. There's a probability. Sometimes as price goes against you, you will lose the entire percentage, right? But most times you're going to have opportunities to manage risk. Sometimes you're not going to have opportunities, and that's just the odds of trading, right? But most times, I stress this again, most times you will have an opportunity to cut your losses short. So, together, let's take a look at this right here. Now, let's say, for example, price is at a support, right? Price is at a support, and we're going bullish. We're in an uptrend, and price, if it wants to go up, it needs to create a support. And you're looking at, the high created up over here, and this candle, basically, we came down, and you're looking at a support to be formed, and boom, you have a support formed. This is your high at this point, and let's say that this range is about 40 pips, because this is a pound yen or gold or whatever pair this is, right? You have a 40 pip range, trend is up, and we've created a support. Now, we've created a support. Now, let's say this is a 30-minute time frame, so we're going to mark this down right here, right? So this is a 30-minute time frame, and now you're saying that, okay, there's a high probability for the next 30-minute candle to continue pushing up. So what are you going to do, right? Let's say, for example, that we're going to use static risk. Managing risk is always good when you're using static risk. When you're using dynamic risk, your risk is already managed. There's no, further managing risk on a dynamic risk. You're basically over-managing risk. And trust me, that's a term. When you over-manage risk, that's a term. Like a lot of you guys were watching this again from Market Fluidity. I understand that some people over-managed risk, and that's not good. Don't over-manage risk, right? Only do it once or twice. So let's say static risk. So you're going to say, okay, you know what? I'm going to enter a buy right over here, right? You're going to enter a buy. And this is going to be, let's say, 1%. You're risking a total of 1%, and you're going to take a buy at this point. And obviously, your stop is below the previous 30-minute candle. And now you're anticipating this candle to respect this low and then to continue pushing up. If it continues to push up with respecting the previous low, awesome. You got a winning trade, you got full 1%. Now, let's say, for example, now we're going to break down this 30-minute into 15-minute candles. Let me do this. So let's do this. I'm trying to see where we have clean area. Okay, let's do this right here. So let's say, for example, that this 30-minute candle represents two 15-minute candles that look like this, right? You got two 15-minute candles. Oh, made a mess about it. So you got two 15-minute candles that look like this, okay? Now, you have the new 30-minute candle starting now, which means that you're trying to take a buy on the next 15-minute candle. So you take a buy right over here, and that denotes a 30-minute candle right over here. You've taken a buy, and this is where the candle starts. Now, if this 30-minute candle respects the previous 30-minute candle's low, your trade is still valid, and then, price can go up. What this means for the 15-minute candle is that if this 15-minute candle starts to go bearish and it closes bearish, now there are two variations, right? Remember, if it closes bearish, you have to close 50%. So from here, we're going to close 50% of the trade. If you had let's say a 1 lot running, you're going to close 0.5 lot. if a 15-minute candle closes bearish, and I'm going to tell you why. The reason why is that if the 15-minute candle has closed bearish, then there's a probability maybe the next 15-minute candle can continue to go down. And if the next 15-minute candle continues to go down without you closing 50%, now you're going to lose your entire position. Okay? Because if price has to go down, you have to remember, don't let your complete position go in a drawdown. The idea of managing risk is to never let your full position hit a stop loss. That's the whole idea. So the first variation is when the 15-minute candle is closing bearish, boom, 50% off the table. No matter what, 50% off the table when a 15-minute candle closes bearish. Now, if, let's say for example, the 15-minute candle does not close bearish, and if the 15-minute candle breaks the low, right, let's say that this candle is still open, breaks the low of the previous candle, this one, boom, 50% off the table, 100%. Because if it's breaking the low and respecting the high, what are we doing? We're making a short downtrend at this point, right? If the 15-minute candle respects the high and breaks this low, 50% off the table, 100%. You're taking 50% off the table. You're not giving market a chance to take your complete stop out. That's the deal right here. Because if it has to go up, it has to respect the dynamics on the smaller time frame as well for buys, right? If it has to go up, the 15-minute candle has to respect this low and then continue to push up, and overall making the 30-minute candle go up as well. It has to respect the low. 100%. It has to respect the low. Now, there's a question that may be coming up, and that question would be, oh, but what if a 15-minute candle closes bearish, okay, and we close 50%, and obviously this first 15-minute candle is the half of the 30-minute candle, right? What if the second 15-minute candle starts to go up and then continues to go up on the second one? Then what are you going to do? Well, in that case, you're going to be using the concepts we talked about in how to give your trade a second chance. Or you're going to use the concept we talked about, adding positions to a winning trade. Now, if it does start to go up, that means that maybe the first half of the 30-minute candle wicked down and the second half started to go up. But honestly, I've seen this happen very rarely, very rarely that we've had a bearish 15-minute candle and then the next one has gone up. It does happen very, very rarely, but it does happen, but also at the same time, it's also very important to be risk averse, right? You have to mitigate risk. It's very, very, very important. So whenever I'm using static risk and I'm looking at the 30-minute time frames, if the 15-minute candles break the previous low, I'm taking 50% off the table. Right? If I'm taking a sell on the 30-minute time frame and the 15-minute candles are breaking the high of the previous 15-minute candle, I'm taking 50% off the table. If we do continue to go in our direction where we thought price was going to go, then either I'm going to let whatever's left is run, or if there's an opportunity, I'm going to add that risk back to the trade. And that's what we've talked about in another section here as well that you can look into. Okay, when we're using dynamic risk, there's basically when you're using dynamic risk, you can't really manage risk because from the get-go, you've already managed risk on that dynamic risk. Because if you're using, let's say, total one lots right here, so dynamic risk would basically mean that let's say you're breaking this down into one 0.5 and another 0.5, right? So you're taking 0.5 right here, and you're taking 0.5 right here as a new 15-minute candle is forming. That's basically managed risk there anyway, because your total risk is one lot, and you have a 0.5 open, and you're basically entering the second position based on what we talked about earlier, right? So dynamic risk is perfectly fine. Whenever you're using static risk, that's when you're managing risk. Right, now, risk management, it takes practice, it takes time. Don't don't assume that you're going to get really good at managing risks. It's going to take time. It's going to take time to accept losses. The biggest problem people have is to really accept your losses. If you're not going to be able to accept your losses, you're going to overtrade, you're going to over-risk, and you're just going to compound your losses. Man, trust me, if you have a solid trading plan, right, and your trading plan says that you're only going to risk 2% or 1%, and you're going to manage risk on those trades, your trading plan is going to be rock solid. Your trading is going to be amazing. You're going to have a higher confidence. Your ego is going to be up. You're going to be more confident in executing trades, knowing that you can manage risk. And also, another thing, right? And this happens to all of us. Whenever we increase our lot sizes, guys say, oh, you know what, I'm super scared, I'm super anxious to increase the lot sizes. Raja, you have any tip? The biggest tip is this. Whenever you're increasing your lot sizes, just understand that you can manage risk. If you're going up from a 50-cent lot to a 1 lot, and you're kind of like scared at that point, just know this, that what's the worst that's going to happen on a 1 lot, right? If your stop is, let's say, 12 pips, for sake of simplicity, 12 pip stop loss, 1 lot, you may lose $120. But if you know how to manage risk, you may lose $80, right? You may lose $70. So that's the win in itself. If you're defeating your risk and you're losing less than what you planned on losing, that's perfect. And before we end this, understand this very, very carefully, right? In the start, it's very normal for you to focus on wins. It's very normal for you to focus on making the most amount of money, the biggest trades, and the best trades. That's perfectly fine. But what happens in the beginning? Everyone starts to lose money. So what are you going to do at this point if you start to lose money? Are you still going to focus on making great trades and great wins and lots of money, and you're going to keep overtraining, over-risking? No. The only thing you're going to do is to focus on how to stop the bleeding. And bleeding here means you losing money in the markets. You can't do that. That's the first thing you need to focus on. And honestly, in the beginning, when I first started, if someone would have told me, hey, Raja, listen, what you got to focus on first is how to manage risk. And what we did in the beginning was to how to make the most money, how to compound the most money, how to keep compounding and making these millions and gazillions, hundreds of thousands of dollars. No, it all came down to now. What I know now, if I knew this back then, my trading journey, very easy, very quick, very robust. You know, because in the beginning, we have to focus on manage risk. Take pride that you can manage risk. Whenever I lose a trade, I take pride in that, because my loss of a trade, it determines that, hey, you know what? I wanted to lose 2%, but I lost 1%, or I lost 1.5%. So in a way, that's also a win for me, right? Now, watch this virtual class again, and there's some things that you really have to incorporate in your trading. If you don't incorporate these techniques in trading, these even psychological techniques, that it's okay to lose, but lose less, aim to lose less, even ending the day with losing less than you planned is a winning day in itself, trading will be very easy for you, very simple. There are a lot of people in our groups here that do the same. They lose less, they have a strong command on their risk management that they can lose less. And that's where you win more. Because at the end of the day, you cannot control the amount of money you're going to win. Because price is just going to go where it wants to go. You can't control that. But what you can control is what you're going to lose in the markets. Take care.